Hello and welcome to BQ Prime. India's retail inflation had eased to a 4-month low when data came in on Monday. It came in at 4.87%, that's the print for October, compared to 5.02% that we'd seen in September. Core inflation saw a little bit of an easing once again, while food inflation was fairly steady. To throw some light on inflation trends going forward, we have with us Teresa John, economist at Nirmal Bank. Ma'am, thank you so very much for taking time out for us today.
Thank you, Pallavi.
So, I'd like to begin the conversation with the inflation print we recently saw. What is the expected trajectory going forward? Would it be fair to say that the next print is likely to see a little bit of an upside from here on because of waning base effect?
That's right. Going forward, we could actually see slightly higher prints because 4.9%, was a low. I mean, it was slightly above our expectation, but you've seen onion prices also go up starting the second half of October, and overall vegetable prices, even in the October print, have gone up. Apart from that, we've not seen in core inflation, we've not seen the impact of higher gold prices reflected as yet. We've seen gold prices go up over the last 2 months. So we overall, the way that we are looking at, yes, the headline inflation could be higher, around 5% over the next couple of months. Core inflation could go up a tad from current levels, mainly led by higher gold prices. Vegetable prices could remain elevated at least in the near term, but I think at least by December you could see vegetable prices starting to come off. That could provide some support for lower food inflation.
All right. So, does this print change anything at all for the Monetary Policy Committee?
So in the near term, no. So in the December policy, we're expecting a status quo. We see probability of a rate cut. I mean, it's a small probability, but from a rate cut starting from Feb 24 itself. That said, the rate cut cycle we expect it to be shallow and compared to past rate cut cycles that we have seen. So, I mean, the one reason why we see Feb 24 as a possibility is, like, if you look at 1 year ahead inflation, you're looking at inflation averaging somewhere around 4.5 to 4.7%. And if you are at a 6.5% repo rate, you effectively have a nearly 200 basis point real interest rate. Which is quite high. I think even the RBI's comfort level is around 1%, a little above that. Secondly, I think the US inflation numbers have also, been quite comforting. So while the Fed may not cut rates anytime in the near future, we are probably seeing an end of the US rate hike cycle.
All right. So, before we delve a little bit into how other high frequency indicators have been performing, I did want to ask you about initial concerns on Rabi sowing. So, we did see Kharif sowing come in almost about steady compared to an year ago. There were some concerns around Rabi because of fluctuations in rainfall patterns. What is it looking like at this juncture, and what's the likely implication on cereals and pulses, which have anyway continued to remain at elevated levels and continue to pose risks?
So the Rabi sowing, I mean, surprisingly, we don't have the complete data. So we actually don't have the data for wheat. But if you're looking at the other crops on a year-on-year basis, it's slightly higher, led by mainly pulses and coarse cereals, which is some comfort given that the pulses sowing in the Kharif season, was around 6 to 7% lower on a year-on-year basis. So probably the pulses inflation could come off a little if this trend continues. On cereals, I think we will not see prices go up significantly from current levels. But I think even the downside is limited, at least in the near term. So rice prices remain elevated, and at least the early trends that we've picked up from some channel checks is that compared to what the government has estimated, it could be slightly better because the harvest has been good despite the delayed sowing that has happened. So the way that we would look at cereal inflation is that we do not see too much of an upside from here. So the prices may not go up from here, but we don't see it coming down as well.
All right. So, moving to other high frequency indicators, some of them, for instance, motor vehicle registrations, have seen a little bit of a bump up because of the festive season demand. What are other high frequency indicators looking like? How much of a boost has the festive season provided to the economy from a near term perspective? What's the outlook looking like?
So the October high frequency numbers are looking good. So it's probably slightly better than September. And if you look at it on a sequential basis, that is on a month-on-month basis, there definitely has been improvement when compared to September. As you mentioned, auto sales are looking good in the festive season. But at least the sense that we are getting from the ground and even from the news that is coming in is that in other categories, particularly offline sales, if you're looking at some items like apparel, so that's textiles and even consumer durables, the festive season has not as been as good as expected. So probably you still get year-on-year growth because last year the festive season came in earlier, and this year it's a little later. So we're seeing most of the impact coming in 3Q FY24. So you will get some support to growth overall, but at least in some categories, and even if you look at airlines, they've had to cut prices at the last moment because the occupancy levels were not as good as expected. It's not been bad, but probably when compared to expectations, it's not been as good.
All right. So, also adding to that, there are a couple of other high frequency indicators. For instance, industrial production, that does not seem to have caught on some of the sheen that we've seen in some other high frequency indicators. What are the causes for that?
So the industrial production number that we got in that was for the month of September. So there has been some slowdown, but October numbers may look better because, as I said, the festive season was slightly delayed this year. So we are expecting the October number to pick up from the September levels. But after that, I think industrial production could see some moderation from definitely from the 10% number that we saw for the month of August, and probably it may be around the levels that we've seen in September, could be slightly lower than that as well after October is what we think.
All right. So, in all, would it be fair to say that while the economy continues to remain resilient, it is a little bit of a mixed bag when it comes to high frequency indicators and what they appear to indicate?
That's right. So in the near term, it is resilient, but I think there is a good chance of a slowdown, coming through post the festive season. So from December onwards, and even in some pockets of discretionary demand, that's a sense that we are getting. If rural demand does pick up, because inflation is softening and the Rabi crop pans out okay, then you could see some support coming in from the rural areas, even as the urban discretionary demand kind of slows down. If not, then, if you have urban discretionary demand slowing down as well as the rural remaining sluggish, then I think it could be a bigger challenge.
Well, urban discretionary demand could slow down in the coming quarter, while rural is still on wait and watch mode. That's a key takeaway from this conversation today. Thank you so much for joining us. Thank you so much, Teresa, for taking time out for us today.
Thank you, Palak.